Welcome to today's video. If you've ridden volatile stocks from market lows to 100% to 300% gains, congratulations. Now the objective shifts from speculation to preservation. In this episode, we'll explore when and how to pivot from concentrated positions into diversified, broad market ETFs so your windfall becomes durable wealth. To set expectations, we'll walk through the risks of concentration, the benefits of diversification, practical transition steps, tax considerations, a case study, and a couple of quick quizzes. Next, let's preview our agenda. Here's our roadmap. First, we establish context and define idiosyncratic risk. Second, we compare concentration with diversification. Third, we unpack why broad market ETFs tend to stabilize outcomes. Fourth, we show a practical step-by-step pivot plan. Fifth, we address taxes. Then, we examine a short case study and test your understanding with quizzes. Finally, we wrap up with key takeaways. Before we dive in, a brief but important disclaimer. This video is for educational purposes only. It is not financial, legal, or tax advice. Your personal circumstances, jurisdiction, and risk tolerance matter. Always consult a qualified advisor or tax professional before making decisions. With that said, let's lay out the context and the core problem we're solving. Many investors who bought individual names during deep market drawdowns realized outsized gains. While that outcome is exciting, the risk profile of holding a few individual positions long-term is very different from what's required for steady wealth building. Our mission is to convert an opportunistic windfall into resilient compounding. Next, let's define the specific risk that makes concentration fragile. Idiosyncratic risk is the company-specific risk that a single business can fail, face litigation, miss product cycles, or be regulated in ways that impair returns. When portfolios are concentrated in a handful of names, this risk is amplified because one failure can severely damage total wealth. Diversification across thousands of companies dramatically reduces the impact of any single company shock. Survivorship bias often hides how many once great names have underperformed or disappeared. With the risk defined, let's compare concentration with diversification directly. Concentration can deliver large, rapid gains, but it also brings elevated volatility and dependence on a small set of outcomes. The monitoring burden is higher, and the downside from a single company event can be portfolio threatening. Diversification, especially via total market ETFs, typically reduces idiosyncratic risk by spreading exposure across thousands of companies, leading to a more stable experience. While it may not feel as thrilling, it aligns more closely with compounding and long-term wealth preservation. Now let's detail why broad market ETFs are often the tool of choice. Broad market ETFs provide immediate diversification across thousands of companies. Their low fees mean you keep more of what you earn. Liquidity and simplicity make implementation straightforward. Most importantly, no single company's failure can dominate the outcome, which supports a compounding-focused plan. With the rationale set, let's quantify risk reduction visually. This pie visualization contrasts the risk mix. In a concentrated setup, a large portion of risk comes from idiosyncratic, company-specific drivers. After moving into broad market ETFs, the idiosyncratic component materially shrinks, leaving mostly market risk, which is typically more rewarded over time. This highlights how diversification reduces unrewarded risk. Next, let's translate the strategy into actionable steps. Start by defining your target diversified allocation and a clear timeline for the transition. Next, inventory each position and its tax lots. Choose a liquidation approach, such as selling in stages over several months, using price thresholds, or a strict calendar-based plan. As you sell, immediately direct proceeds into broad market ETFs to avoid drifting back into concentration risk. Automate ongoing contributions and establish a rules-based rebalancing schedule, such as quarterly or semi-annual rebalancing. Finally, write the plan into an investment policy statement to maintain discipline. With mechanics in place, the next question is taxes. This high-level table summarizes common tax considerations. Short-term gains often face higher rates, while long-term gains may receive preferential treatment depending on jurisdiction. Realized losses may offset gains within limits. Donating appreciated shares can avoid realizing gains and potentially provide deductions, sometimes via donor-advised funds. Selecting specific tax lots can help reduce taxable gains. Always confirm current rules with a tax professional in your country. Now let's discuss practical tactics to minimize tax drag while still reducing risk. A few practical tactics can soften the tax impact. When possible, delay selling short-term positions until they qualify for long-term treatment. Use specific lot identification to sell the highest cost shares first. Consider staggering sales across calendar years to distribute tax liabilities. Donating appreciated shares to a charity or donor-advised fund can avoid gains and support causes you value. Pair gains with losses in other holdings to offset within applicable limits. Most importantly, do not allow tax considerations to dominate risk management. Risk reduction is the primary objective. To make this concrete, let's walk through a simple case study. Suppose a $100,000 investment is now worth $300,000, split across two volatile names. If you stay concentrated and the names fall 50%, the value drops to $150,000. If instead you sell, pay the tax bill, and reinvest in broad market ETFs, you may sacrifice a portion to taxes today, but meaningfully reduce the probability of catastrophic drawdowns. In many cases, paying taxes on large gains is preferable to risking their disappearance in a downturn. Now, let's outline a time-based glide path many investors find practical. This timeline lays out a year-long, staged approach. It begins with assessing positions and tax lots, then sells roughly 20% in each phase, coordinating with loss harvesting, considering charitable donations, and concluding with ETF purchases, rebalancing, and documenting the plan. The goal is to systematize de-risking while being mindful of taxes. With the plan clear, let's check your understanding with a quick quiz. Question: what is the primary danger of holding a handful of individual stocks long term? Options: higher expense ratios, idiosyncratic risk from a single company failure, lower market exposure, reduced liquidity. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is idiosyncratic risk from a single company failure. Concentrated portfolios are vulnerable to events at the company level. Broad diversification mitigates this. Next, let's try one more scenario-based question. Question: you have large gains in two volatile stocks. Which approach best preserves wealth while managing taxes? Options: hold both indefinitely and hope for the best. Sell all at once to avoid future taxes. Stage sales over time and reinvest proceeds immediately into total market ETFs. Wait for a perfect top and then sell. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to stage sales over time and reinvest proceeds immediately into total market ETFs. This balances prompt risk reduction with practical tax and behavioral considerations. Now, let's consolidate what we've learned. The main points are straightforward. Concentration risk is not sustainable for responsible wealth building. Diversification via low-cost, broad market ETFs reduces unrewarded risk. Taxes are a friction, but not a reason to gamble unrealized gains. Execute a rules-based glide path, automate contributions, and rebalance on a schedule. Next, let's summarize the entire strategy succinctly before we close. In summary, celebrate your successful trades but secure the gains by transitioning to a diversified core. Move from seeking hero moments to building durable compounding. Broad market ETFs offer stability and simplicity. Execute a planned pivot, respect tax realities, automate your process, and codify your approach in an investment policy statement. Finally, let's close with a quick note and a request. Thanks for watching. If you found this useful, please like the video, share it with someone who needs to de-risk their winners, and subscribe for more. In the comments, share how you plan to transition from concentrated positions to diversified ETFs. See you next time.